Investing is the ultimate secret to building your wealth. So if you're looking to take $1,000 and grow it, then you're in the right place. Now your approach is really going to depend on whether this is the only $1,000 you plan to invest, or if you'll invest this now and then consistently make additional contributions, adding more money over time in the future. To start, let's assume that you only have $1,000 to invest, meaning you'll put it somewhere and just let it do its thing. So you've saved up $1,000 and you're planning to invest it in the stock market or even more risky assets. First off, congratulations. You've already done more than the vast majority of people. You saved up that $1,000. Now, the bad news is you aren't going to get rich by just throwing $1,000 into the stock market. Let's look at an example. Imagine that the year you invest your money, the stock market has a major upswing and brings back a return of 25%. This is 15% above the 10% average that most professional investors would jump for joy in getting a return like this. So if you had $100,000 invested in the market, this would be fantastic. You'd be up $25,000. But what about your $1,000? Unfortunately, this is only $250 gain on your $1,000 investment, which isn't exactly life-changing money. Now, many of you may think that the best place to put your money would be a CD or savings account because the returns are guaranteed, right? Well, if we look at the current interest rates, CD will only return like 1 to 2%, and savings accounts are only like 0.5% right now, which is way below inflation. So if you put your money into a savings account for 5 years, you'd only gain around $22, which is pretty sad. Although it is guaranteed return, so you're never going to build any wealth with this approach. Now, what about CDs or certificates of deposit? For those who don't know, these are basically like savings accounts, except that your money gets kind of like locked up for a certain period of time, depending on which CD you choose, unless you want to pay a hefty fee to take your money out. Let's see how this will play out for you. The average CD rate for a 5-year term is 1.42%, which isn't that bad, but sadly it won't give you anything worthwhile, and it's still below inflation. Your $1,000 would grow to a measly $1,073 after 5 years. That's enough to buy a few days worth of groceries or a new outfit, but who wants to wait 5 years just to do something like that? Again, this won't make you wealthy. And even if you were to invest this money in the stock market for 5 years at an average inflation-adjusted return of 8%, you'd still only end up with $1,469. And this is by far the best option out of everything we've talked about, but it really isn't going to change your life. Now, there's no reason to start panicking. Everybody panic! Oh my God! Because there's something you can do that will allow you to make more money so you can invest more money and grow your wealth. Now, most people go through life using only a fraction of their potential. So anything you do to invest in yourself is the best investment that you can possibly make. And then you can follow your passion, whatever that may be. As Warren Buffett said here, the best thing you can do is educate yourself and invest in yourself. This could mean learning a new skill that you can use in your current job, or that you can use to leverage into a new job that pays more money. The more valuable you are, the more money you'll be paid. It's really that simple when you think of it that way. You can invest in yourself through things like online courses, YouTube videos, books, seminars, or even webinars. The more skills you have, the more companies will be willing to pay for you, and the less likely you'll be laid off, which is definitely something to be mindful of in this economy. You can learn sales, social media, marketing, or even learn to code. Now, I know I'll get a lot of slack for suggesting that people learn to code in the comment section, but I come from a tech background, so I see this firsthand every day, and this is the first thing I think of. The key here is to look for skills that are in high demand but low supply. Job skills are like everything else in economics, where it really boils down to supply versus demand. So you want to make sure that you're on the right side of that equation. As Charlie Munger, Warren Buffett's right-hand man, once said, develop into a lifelong self-learner through voracious reading, cultivative curiosity, and strive to become a little wiser every day. The more you learn, the more you grow. And the more you grow, the more your income and happiness will grow. Another thing you can do with $1,000 is to work on creating an additional income source. With the advent of the internet, this is easier than ever, and you can do it without even getting off your couch. You can do freelancing work like Upwork or Fiverr, online tutoring, teaching, affiliate marketing, print on demand to sell custom merchandise, or even become a content creator. Now, The hard part is going to be putting in the work to get your business up and running. However, if you invest in learning and take action, you can do anything that you put your mind to. Then, once you start earning additional income, you can take this money and you can reinvest in your business and you can keep growing it. Once the ball is really rolling and your business is making good money, then you can take that additional income and invest it in the stock market. So, you have a steady income and you've saved up $1,000 and you plan on investing your additional income each month. Now, even if you have money coming in consistently, you always want to continue to invest in yourself, in your education, and continue to grow. And it'll never let you down. Never stop learning. But the real question is, what else can you do? Now, you can only realistically work so much, so your next source of income will have to be something passive, something you can earn while you sleep. So you'll need to invest your $1,000 and any additional contributions each month, and let that money make money for you, while you also work and make money for yourself. This is best personified by a quote from Warren Buffett. If you don't find a way to make money while you sleep, you'll work until you die. And who wants to work their whole lives? Not many, I'm sure. Now, the first and most common way to earn passive income is to invest in the stock market. But when I say stock market, I don't mean invest in the way that everyone thinks of it. For most people, the stock market is a place where you can buy and invest in a huge number of companies. For example, you could buy stock in companies like Microsoft, Tesla, or Google. When you buy shares of these companies or any other company, you own a small part of that company. When the company makes money, you make money. If they lose money, you lose too. This happens either through the price per share going up or down, or getting paid more or less with dividends. Now, by the way, you should invest in the stock market is through indexes, which are basically baskets of individual stocks to diversify risk. This is like the S&P 500, the NASDAQ, or the Dow Jones. Now, Buffett is a clear supporter of this approach. Let's use an example to further illustrate. Let's say you put all of your funds into Lucid stock, but the economy continues to get worse and the stock market starts to follow the real economy. And Lucid still can't make a profit off their vehicles. The Saudi investors, they ran out of patience and they stopped infusing money into the company to keep it afloat. Eventually, they run out of runway and go bankrupt. Now you've invested all of your money into this company, and even though you didn't do anything wrong, you still lost all of your money. The opposite can also happen. Let's say Lucid finally starts turning a profit and is able to start manufacturing a mass market vehicle with Tesla-like margins. This would boost their revenue exponentially, and therefore the stock price would skyrocket, as it's generally a function of the price to earnings ratio. That's the thing about investing in individual companies. You can make a very large return, but there's way more risk. So, if you don't make the right choice or your luck turns around, you can lose everything. Over a 20-year period, only 7% of professional investors outperform the S&P 500. So it's extremely unlikely that an ordinary person like you or I, who doesn't spend 15 hours a day researching and doing math, will beat the market. If you don't have a ton of time to study companies and learn about investing, then it's best to avoid it altogether. There's more to investing than picking the next hype stock. This is where index funds come in. Index funds are essentially a basket of companies you can invest in, meaning you can skip the whole process of trying to find the next big company, and you can diversify your risk. There are many different options to choose from total market, which means like the entire US stock market, for instance, S&P 500, which is the top 500 US companies by market cap, sector specific like tech or dividends, and much more. Even better, you can buy these in the form of an ETF, which is just as easy as buying an individual stock. Now, definitely keep in mind there's no guarantee that you'll make money when you invest, even in an index fund, so always make sure to do your due diligence and don't just blindly do what you're told. You can start with a total market fund, which are safe and reliable, great for beginner options. It's like VTI or an S&P 500 ETF like VOO or SPY. These will give you exposure to the top 500 companies in the US. What you can expect is that if the US economy rises, so will the fund. And if the economy goes down, then you can expect the fund to go down too. If you want to invest more heavily in tech, you can go with VGT or QQQ. These will expose you to companies like Nvidia, Apple, or Microsoft. Now, both of these funds have different companies, so make sure you do your research and see what you like, see what fits you best. Lastly, if you want dividend payouts, then you can consider VYM or SDY, When you invest in this fund, you'll get exposure to a bunch of different companies that pay you to invest in them. So you can also check out my video on how much money you need to invest to live off of dividend stocks to learn more about dividend ETFs specifically. It's very important to invest consistently and dollar cost average. Now, the easiest way to do that is to take, say, 10 or 20% of each paycheck, or whatever you can afford to invest, the more the better, and buy ETFs every time you get paid. If you can set up automatic purchases, it's even better. So you don't even have to think about it, and you can completely separate your emotions from the process. This also means that you won't accidentally spend money that you should be using to invest. As Warren Buffett famously said, do not save what is left after spending, but spend what is left after saving. The second way you can use your $1,000 in additional contributions is through real estate. Now, it's going to be hard to just go and buy a house that you can rent out with only $1,000, but there are plenty of other options available now thanks to the internet. One example is using crowdfunding real estate platform that allows you to place like a small amount, like $1,000, with other investors in a fund to fund that real estate purchase. So if the real estate makes money, so do you. If the property value goes up, you get more out of it too. These platforms primarily pay through passive income that comes from rent. However, it's important to know that this isn't a very liquid investment. Since it's a physical real estate, it's not as easy to sell at home as it is to sell a stock. But if you're comfortable with investing in physical real estate, you don't have the capital to buy your own property, and you aren't considered with not having access to your money for some time, then this is an easy way to get started. Finally, you can invest indirectly in real estate through REITs, or real estate investment trusts. With REITs, you invest in a company that invests in real estate, but it operates the same way. You get paid dividends from the money that comes in through rent and other sales, but without being tied up in physical properties. REITs also tend to pay higher dividends as the companies are required to give 90% of the profits to shareholders. Some examples of REITs are VNQ, USRT. If you're hesitant to start investing right now, then you can do the Dave Ramsey approach, and you can start paying down your debt. This is a guaranteed return too, as you will 100% have to pay the interest if you don't pay the debt down early. If you have any debt at 7% or above, you should prioritize paying this before you start investing at all. If you have any credit card debt or one of those wild 18% auto loans, definitely focus on that. Not only will this be the best bang for your buck, but it'll give you some peace of mind. If you have a 7% interest rate on a loan, paying off early would be equivalent to a 7% return on investment. And it won't fluctuate like investing in the stock market. It's guaranteed. So, if you're afraid to invest in the stock market right now, or you don't want to hop into real estate, then this is your next best bet to get started. It'll allow you to have much more cash available as you have fewer expenses every month. The faster you pay off the debt, the less interest you'll have, and the more money you can keep in your pockets. Then, once you're deleveraged, you don't have all that debt, and you don't have any more liabilities, you'll have extra money and the peace of mind to go ahead and take the leap and start investing. Now, the cheapest investment out of all of this is subscribing to my YouTube channel, as it doesn't cost you anything, and it'll help you get free, helpful videos every week. It would mean a lot to me if you did, and also like the video for the YouTube algorithm. Leave a comment below to let me know what strategy that you're thinking about going with. Thank you so much for watching, and I'll see you next time.